Hello, this is Steve Santangelo once again from the SRS Rock Report. And today I have a short update on how I see gold and silver trading during the upcoming market crash, which I believe will start to take place this fall. Now, I've received a lot of questions, emails, and I've seen people discuss that they believe gold and silver are going to fall like they did back in 2008. Now, even though we could see a correction, we're seeing a correction now in the metals, I don't see it behaving the same way that they did in 2008, and I'll explain why. Now, let's first start with the Dow Jones. Now, the Dow Jones Index is trading at 25,200. However, its 200-month moving average, which is the red line, is a 13,530. So the Dow Jones is trading 86% right now above its 200-month moving average. Now, if we go back to 2008, right before the crash, the Dow Jones 200-month moving average was right around 8,000, and it was trading about 14,000. So it was 76% above its 200-month moving average. Well, we could see now the Dow Jones is trading 10% higher than it was in 2008. Now, the S&P chart looks very similar to the Dow Jones. And what we see here, which is the same thing, except the S&P is trying to move above its high in January. It's trading at 2,830. However, its 200-month moving average is 1,506. So it's 88% trading above its 200-month moving average. Now, if we go back to 2008, when the S&P was trading, looks like about 15 and a half, its 200-month moving average was 940. It was way down here. It was trading 67% above its 200-month moving average. So we could see it's 20% higher today. Now, the biggest overvalued index is the NASDAQ. The NASDAQ is a little bit different than the Dow Jones and the S&P because it's trading 145% above its 200-month moving average. Right now, the NASDAQ is trading at 7,833. Its 200-month moving average is way down here, 3,200, which is 145% above its 200-month moving average. Now, if you go back to 2008, the NASDAQ was only trading at about 2,800. So its 200-month moving average was 1,700. So there wasn't that much of an increase. It was only 68%. But if you go back to 2000, this is where the dot-com, the tech stocks really overvalued. So we're seeing that the NASDAQ, similar to the 1990s, it's more overvalued, and that's because of the FANG stocks, Facebook, Apple, Amazon, Netflix. Google, these stocks are severely overvalued. Now, I want to show you an indicator that also gives us an idea how much the markets are overvalued, the leverage. This is from Sentiment Trader. I subscribe to this service. It's an excellent service. And this is NYSE available cash. Now, basically, these are the traders, and how they get this available cash is they take their margin debt and minus how much money they have in their account. So if you have 50 in margin and $10 in your account, the overall would be a negative 40. So they're looking at the whole market. Now, what's interesting, the NYSE available cash is a negative 310K. I believe that's 310 billion, but this is their indicator. Now, if you go back to 2007, you'll notice that the NYSE cash was not that negative, but it's extremely negative now. Now, back in 1999, 2000, it was like 110K. So compared to 2000, the NYSE available cash is 3 times higher, with negative. And this next indicator, which is the NYSE margin debt. I have shown you several charts long-term. I will show you that a new chart here in a minute, but I wanted to show you the short-term chart. This is 6 months. Now, we know the markets peaked at the end of January 2018, and at that point in time, the NYSE margin debt hit a record like 665 billion. And the S&P moved higher. This is the S&P index. But as the S&P index sold off, so did the liquidation of the margin debt. Now, as the S&P started to move higher, so did the margin debt. But what's interesting, in July, and this is for the month of July, while the S&P moved up gradually, we saw a huge decline in the NYSE margin debt. I think that's an indicator that the traders are starting to get spooked. And if we look at the long-term chart, we could see just how much leverage there is. And this is the S&P 500, peaked in 2000, fell, peaked in 2008 and fell, and now we're here. Now, what's interesting, even though it's fallen at 645 billion, it is 55% higher than what it was in 2008 before it crashed, and 115% higher than it was in 2000 before it's crashed. So as we can see, the NYSE margin debt is in extreme bubble territory. And when you look at how overvalued the stocks are, the indexes are, NASDAQ, how overvalued it is, even the S&P. This is the reason why I believe we're going to start to see a correction this fall. Now, if we look at Amazon, and Amazon is one of the typical poster child of what's wrong or highly overvalued in the market, Amazon is trading at $18.96, almost $1900 a share. You go back to 2014, it was trading at $400. Go back to 2008, it was trading at no more than 100. It's now 19 times higher. But this is the important thing. The 200-month moving average for Amazon is 292. It's 550% above its 200-month moving average. This is a very huge warning sign. Now, we can't go back and compare it to 2008 because there wasn't a 200-month moving average in 2008. Anyhow, I just wanted to show you how overvalued these stocks are. Now, interesting, gold is behaving and silver are behaving a little bit differently because gold and silver spiked in 2011, and they've been selling off and basically been remaining flat for the last 4 or 5 years. Now, gold is currently trading at 1,200. Its 200-month moving average is 985. It is only 22% above its 200-day moving average. Now, if we go back to 2008, gold was trading at about 970, 980. It did hit 1,000, shot up and came down, but it closed about 975, 980. At that time, its 200-month moving average was 400. Gold was trading 145% above its 200-month moving average in 2008. That's why it corrected. But as you could see, when it corrected, it didn't fall below its 50-month moving average. It didn't even get close to its 200-month moving average. Now, gold is trading right at its 50-month moving average. So even though we could see a correction, I highly doubt, and even the break even for the gold miners is 1150. Whoops, let's go back. It's 1150. So even during the market correction, we could see a spike lower, but I believe we're going to see gold turn around in this after the initial massive stock market correction. Now, another indicator that tells us that gold isn't in serious trouble, like heading back towards $750 or $400 an ounce, is that the gold short hedging positions are now back to near record lows. And here they are. And when it gets high, when this line starts moving up, this is when the short positions come back to their lows. And in 2016, when gold hit a low, we can see its short positions were about the same where they are right now. And gold was trading below 1100. I believe it was trading at 1,080 or something. Well, we're trading now 1,200, $100 more, and this is where the shorts now. They have liquidated, and now they're getting back to their lows. So it doesn't mean that we can't see the short positions or the commercials with going net long. That could happen. But again, when the markets really start to correct, I do believe we will see the gold and silver price turn around. And if you think gold is closer to its 200-month moving average right here than the markets, silver is actually below its 200-month moving average. And as you can see, silver is trading at 15. It fell below 15 today on trading on Monday. Its 200-month moving average is 16.18 right here. And the price is below that. So it's actually 7% below its 200-month moving average. And the break even now for the silver miners is $15, $16. And I believe First Majestic came out with results today. They lost a considerable amount of money. The stock was down 15%. So the silver price is now very close to its cost of production. But the reason I don't see it falling down towards 8 or 9 like it did in 2009 or 2008 was in 2008, silver was trading here, $20 an ounce. Its 200-month moving average was $6.50. It was trading 208% above the 200-month moving average. And I imagine cost of production was about, what's interesting, the 200-month moving average gives us an idea about the cost of production. So this price of silver was trading much higher than its 200-month moving average as well as its cost of production. Today, we don't have that same thing. Silver is below its 200-month moving average. It's also now going below its cost of production on many primary silver mines. Now, I'm not saying that the silver price can continue lower, spike lower, but if I had to choose where I was going to put my money, the risk. Silver is low risk. And according to Charles Nenner, and I do enjoy looking at Charles Nenner's work, he's a market timer looking at cycles. And he sees the cycle in the Dow Jones and the markets has peaked. Even though the prices could head up higher, he sees a correction starting this year. But he sees after the summer a good buying opportunity for gold and silver, because normally during the summer, silver and gold don't do well. They start doing much better in the fall. And so when you put together a coming market crash, or let's say a beginning of a correction starting this fall, and then the silver price being at its 200-month moving average, I really do believe that the metals will be one of the few places to go when things start to fall apart. Now, just like gold, the silver short hedges are trending back towards their lows. They're not like their lows they were a few months ago, but they're trending back towards their lows like they were in the beginning of 2016. Now, because silver has more of an industrial component besides gold, like copper and oil, silver is impacted more as an industrial metal than gold is. But I do believe when gold turns around, it will take silver up with it. Now, I wanted to show you once again, to conclude, just as a comparison, how overvalued the markets are, especially the NASDAQ. With the NASDAQ trading 145% above its 200-month moving average, very similar to how high it spiked when it was trading at about 5,000, when its 200-month moving average looks like it was 1,100. It is the most overvalued index, even more than Dow Jones and the S&P, and that's due to these FANG stocks, these highly overvalued FANG stocks. And we could see the same thing with the Dow Jones. Even though the Dow Jones isn't as overvalued, it's a little less than half in percentage terms. It's 86% above its 200-month moving average. Now, this is the reason why I see the markets correcting much lower, coming down back towards the 200-month moving average. When the stock markets do start to correct, we could see gold and silver fall with them. But just like they did in 2009, gold and silver turned around and started moving higher. Now, this is the last chart, and it's up to about 2014. And these are US recessions. And you'll see that the typical cycle is about 7-8 years. And between 2000 to 2007, we had the recession. And then the recessions are shown in blue, and then the unemployment rate. So right before the recession, we have low unemployment. And then when the recession hits, unemployment goes up. And then when the market turns around, unemployment goes down, shoots up. And we see the same thing happen over and over again. Now, even though the economic the indicators, the unemployment data is rigged, if we just go by what they're saying on their part-time unemployment, even though actual unemployment is more like 20%, but if we go by their figures, which they're saying it's 4%, it's now 2018, it's here. Unemployment, according to their data, is back here. But you see, reaching an unemployment, even due to their highly manipulated unemployment figures, it's not a good sign. It's not a good sign to have low unemployment. Anytime you get to low unemployment, there is a recession. And even Charles Nenna says this. So now we're at 4%, according to the US government statistics. This is just another indicator that shows us we are very close to another recession. And I believe this one could turn into a depression that we'll never come out of. Now, we may have hyperinflation coming out of this next economic recession, depression. We could have hyperinflation for a short period of time. But again, I just want to show you the difference between the gold and silver are very close to the 200-month moving average, especially silver. Gold is holding up better than silver because it's more of a monetary asset. Silver is the less loved metal. It's more of an industrial metal. And so we're seeing it sell off more than gold. But I think silver will actually behave much better than gold when they start correcting and going much higher. Now, I want to conclude by saying I'm going to be doing some more videos on updates of the markets and how I differ from a lot of different analysts. And I was listening to Dave Stockman, who I have a lot of respect for, and I agree with him. We're going to have a market crash. Everything is overvalued. But he believes, just like we've had over the last 100 years, that when the markets crash, GDP falls, the Dow Jones, the NASDAQ, and S&P fall, all these stocks implode. Well, then he says you need to be out of the markets, you need to be in cash, because when the markets bottom, then it's the next leg up, the next bubble. I differ, and that's due to the energy. This time around, we're not going to have the energy to pull us out, because we have to remember, from 2007 to 2018, U.S. has added 5 million barrels of shale oil production. And most of the increase in global oil production is due to mostly shale and some Canadian. So when U.S. shale production peaks and declines, we're not going to have the energy. global energy production will start to decline. We're not going to have the energy to pull us out. So I see a much different future than a lot of these other analysts. Well, I wanted to thank you for joining me on this new update. Please, if you haven't subscribed to the SRS Rocco YouTube channel, please do. And please stay tuned for new upcoming videos. Thank you.